The logic of rule of 100 is just basically this. The younger you are, the more risks you could actually take. The younger you are, the more money you can deploy, the more capital you can deploy into assets that can give you a higher rate of return, but also volatility. It just actually means this, if you are in your 20s and then you invest more in the stock market, then suddenly it crashes, you have more time for you to be able to accumulate more or wait it out or build the skills so that you can recoup whatever losses you got. Hey guys, so in this video, I want to talk about the rule of 100. What is it? Is it good? Is this something that will help you? And is the logic actually sound in all of this? With one goal in mind, to be able to give you the right information so you can invest properly, so you get to reach your goals of financial freedom. So I first heard of this rule of 100 when I was starting out. It was one of the first, I guess, investing / finance principles that I learned about when I was starting. So basically, the rule of 100 is this: 100 minus your age, whatever that amount, that should be your allocation in the stock market, and whatever is left, that should be your allocation in fixed income instruments or in bonds as well. So when I started investing, I think I was around 22 or 23 years old at that time. Let's just say 23 years old. So if I would have followed the rule of 100, 100 minus 23 equals 77. So that actually meant that 23% of my entire portfolio that I would have used for investing should have been placed in bonds or in more conservative investments, and the remaining 77% should be placed in stocks or equities. Full disclosure, I actually don't follow the rule of 100 because when I started out, I was pretty much heavy in stocks. I was pretty much heavy in equities. I was heavy in asset classes that gave me a lot of growth, that gave me a lot of variability, that gave me the potential to earn more. But as I got older, I started to position more in bond. Let's try to break this principle down even further. So this actually means that if you follow the narrative right now, I'm 37 years old. So if I would follow the rule of 100, that means 100 minus 37, that's the amount of money that I should put in stocks and in equities. So if you would compute it, 63% of my portfolio should be in the stock market and the remaining 37% should be in the bond market. Even up until now, I'm still not using it is because I know I've placed more in bonds, in savings accounts, and in fixed income instruments over the past decade or so. As I started also to get older, I started to shift some of my investments that give me volatility and growth in something that gives me safety. Please don't memorize the numbers just for the sake of memorizing it, because when you hit 40, you'll say, oh no, 60% na lang pwede ko lagay sa stock market, 40% pwede ko lagay sa bonds. So that also means that pag 80 years old ka, nako, 80% dapat nasa bonds, 80% dapat nasa fixed income instruments, 20% na lang sa stock market. Above and beyond memorizing numbers, above and beyond just taking them as principles, you look at the logic behind it, because when you look at the logic behind it, that's where it becomes very, very powerful. That's where it becomes very, very interesting. Why? The logic of rule of 100 is just basically this. The younger you are, the more risks you could actually take. The younger you are, the more money you can deploy, the more capital you can deploy into assets that can give you a higher rate of return, but also volatility. It just actually means this, if you are in your 20s and then you invest more in the stock market, then suddenly it crashes, you have more time for you to be able to accumulate more or wait it out or build the skills so that you can recoup whatever losses you got. But if you do that in your older age, say 50, 60 years old already, you cannot take more risks anymore because you are not as productive. You cannot take more risks anymore also because you're about to retire as well. You cannot take more risks anymore because if something fails and then you don't have a lot of income coming your way, then it would be harder for you to be able to recoup it. So the principle, in my opinion, is very, very, very sound. But what I did was basically this. When I was younger, I actually went a large chunk into the stock market, into the equity market. Then as I started to feel that, okay, I think I'm getting older, I think I need to put a certain amount already into something that's fixed. I need to focus also on cash flow. That's when I started to develop and build assets that were relatively not as risky as compared to directly investing in equities or in the stock market as well. So how does this apply to 2021? If you are watching this and you are investing right now, what could you actually do? Get the principle. And it does not just apply, in my opinion, just purely for the stock market, because you can also use it also for cryptocurrencies. You could also use it for Forex. The younger you are, the more you put into these three assets: stocks, cryptos, and Forex. The older you get, the more you need to deploy capital into assets that are fixed, that are safe, maybe preferred shares, maybe bonds. When I say bonds, corporate and retail treasury bonds, and also fixed income instruments. So that's what your style is supposed to be. Don't just focus on the number, focus on the principle behind it. But I've been saying this in a lot of videos that if you want to get fixed revenue, don't just focus also on the percentage that you will allot. Focus on magkano nga ba yung gusto mong makuha. Meaning, if your expenses on a monthly basis, say, example lang is 10,000 pesos, that means for you to be able to survive on a yearly basis, you need 120,000 pesos. So what does that actually mean? It actually means that what you need to set a target for is, number one, how much should I put in given a specific interest rate, say 5%, for me to be able to get 120,000 pesos on a yearly basis. So to make it also super simple, think about it this way. If you have 1.2 million pesos earning at 10%, that means every year you would get your 120,000 pesos a year. However, if you have 2.4 million pesos earning at 5%, that means you get your 120,000 pesos per year. Your target, your goal is not to actually ilan percentage dapat ilagay ko sa bonds, ilan percentage dapat lalagay ko sa magbibigay sa akin ng 120,000. No way. It's more of the amount. Focus more on the amount of money that you need for you to be able to hit that goal. Focus more on the amount of money for you to be able to get your cash flow, for you to be able to get that passive income amount that you were targeting to get. So does the rule of 100 work? I think it's a very, very good principle, especially for those who are starting out. I think it removes all of the computations and it makes it very, very basic, so that if you don't want to know the nitty-gritty and just the principle behind it, it's a very, very simple formula. Okay, 100 years old, 50 years old ako. Okay, 50 sa mga investments that are volatile, 50 sa mga investments that can give me growth, then 50 sa mga investments that will be relatively safe. Pero I want to say this also. No matter what happens, you always invest into something that you know you are already good at. You invest into something that's where the competence is. Do not invest just for the sake of balancing your portfolio. Kung mas alam mo talaga yung stock market kaysa other asset classes, it does not make sense for you to venture into something just for the sake of venturing into it, pero hindi mo naman talaga alam, because you will lose money still eh. The name of the game is, it's all about what you know, it's all about what your knowledge is, and it's all about deploying capital based on what you know. I'm putting lang a caveat into it that if you want to follow that rule, you always put it under the notion that, okay, mag-a-allot ako ng extra dito, pero dapat pag-aaralan ko pa rin. So, you know the problem naman when you're younger, then you're heavily into safe assets. The problem there is you will have to force yourself also to be able to invest into assets that are better. When I say better, that will give you a better rate of return. Pero when every time you take on something that has a greater degree of risk also, the more you have to study. And it could be a realization point, I think, for everyone watching this, that you assess your portfolio. Kung bata ka and majority of what you own right now is in something that's safe, then I think also there's something wrong there, kasi sayang eh. You're missing out on opportunities that are possible since you're young. Inflation might eat you up alive. You're putting a large amount of money to something that's fixed. Guess what? Over a 20 or 30 or 40 year period na tulog yung pera mo, inflation will just keep on beating you. And please remember this, the more governments keep on printing, the more that the US government is devaluing their currency, the more we see widespread fiat out there. The value of it gets smaller and smaller and smaller and smaller. And that's a very reason why you need to stockpile on assets that will allow you to have growth. So list down all of your assets, all of your savings, all of your investments, then check yung proportion na. Para super simple lang, you can actually do this. Alin dito yung safe, alin dito yung medyo may volatility. Tignan mo, kung bata ka, then mas madami kang nakalagay sa medyo safe, then I think there has to be a realignment that has to be done also, that okay, I'm young, I need to actually take on more risk. Then on the flip side, if you are 45, 55, nearing 60 years old, but from my channel, I think a lot of you guys are relatively my age, mid-30s to mid-40s, and then we have some that are in their late 20s also watching this, that, okay, I'm in my 40s, I can still put a large amount of money investing in something that is variable. And that's what gave me confidence. And I'll say this, and I'll just end the video with this, that's what gave me confidence to start investing in the stock market early on. And I wasn't scared about crashes. I wasn't scared about bearish markets because I knew I was young. And to everyone watching this, markets will crash, markets will fall. That's always part of the game. We always would see markets crash. Please do remember, those are cycles. It's not a question whether markets will go down. It's only a question of when. And the greater question that you need to realize is what you are doing in the midst of that downpouring. What are you doing when everything is down? What are you doing when things are not going the way you want it to go? But if you're young, you can ride that. If you're young, when it's down, it allows you to stockpile, it allows you to accumulate, it allows you to get better, it allows you to position for a recovery. And that's why if you're young, you need to stockpile, you need to accumulate, and you need to take as much risk as possible. Not for the sake of taking risk, but to realize that it's an investment that you study the risk, you know what is it, and then you start deploying capital. And here's the thing, when I started out, all there was that I knew at that time was the stock market. Yun lang yung alam ko eh. And yun lang yung available at that time. The access to investments isn't like what we have right now eh. It isn't as widespread. It isn't as easy to come into. It doesn't require a large amount of capital. If I was in my early 20s right now and just starting, I would have invested right away in the cryptocurrency market. I would have invested right away in the Forex market. I would have invested right away in the US stock market. Then I would have still positioned in the Philippine stock market. In the same way, in all those 4 asset classes, I had the ability already to gain the skill and have exposure to make my money work hard for me. So if you want to try that, check it out down below. Binance, $10 US, you get to buy cryptocurrencies. Go Trade, $1 US, you get to buy US stocks. Then you also get to buy Philippine equities for 50 pesos, even if you're using GCash as well. But that being said, also, you can trade the Forex market using XM. When you start to open an account with them, you get to have $30 US added to your account that you can actually use for trading. The younger you are, the more aggressive you should be. The older you are, the more conservative that you can be, but you always deploy capital in your circle of competence. You always deploy capital into something that you have studied. It does not make sense to put in money into something that you do not know, no matter how categorized it is as either safe or something that's more volatile. No matter how safe the investment is, if you do not understand it and if it does not fit you, then do not go for it. I really believe that the rule of 100 is sound, it works, and the principle behind it to take as much risk and volatility and growth as possible when you're young is very, very good. That's what I did, and I do hope you take the time to study it as well. I hope this video helped you and this is something that gave value to all of you. If you want more videos about this, like, share, subscribe, and smash the bell so you get updated every time I come up with new content about investing. So this is Marvin Gurmo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, and God bless you all.